Let's figure out if Pan American is a buy or a sell. Let's get started with the model. This is a mid-cap company, 9.1 billion market cap. They're trading at $25 a share, and they have 360 million shares outstanding. Pan American Silver engages in the exploration, mine development, extraction, processing, refining, and reclamation of silver, gold, zinc, lead, and copper mines. The countries they operate in are Canada, Mexico, Peru, Bolivia, Argentina, Chile, and Brazil. Their headquarters are Vancouver, British Columbia, Canada. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow was positive in 2021, then negative in 2022. It looks like they had a drop in revenue that year, which probably led to negative net income, negative free cash flow, but it's back to positive in 2023, up 62% in the trailing 12 months to 115 million. They do pay a 1.5% dividend, which cost them $143 million. So they cannot cover the dividend with their free cash flow. They can only cover 80% of it, which means they're going to need to add debt to fund their dividend. Net income is the profit or loss on the income statement. It's revenue minus expenses. Positive 100 million in 2021, but negative after that. They probably have lots of write-downs. The reason I pretty much know that is because they have positive free cash flow, except in 2022, but 2023 and the trailing 12 months are positive. That means the income statement has lots of non-cash items like impairments, goodwill impairments, asset impairments, depreciation, stock-based compensation, etc. Revenue is a sales for the company, and that did go down from 21 to 22, up 55% in 2023, up 11% in the trailing 12 months at 2.6 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 9.7 billion. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of $8.4 billion. We divide that by 360 million shares. And we get a calculated stock price of $23. They're trading at $25, so they're trading at 8% premium. It's a sell according to the model. What do you guys think? Do you think it's a buy or a sell? Let me know in the comments. There are 42 companies in the same industry as Pan American, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend about 400 million in CapEx. When they acquire a location and build out the mine, those are CapEx spends. Debt to equity ratio 0.2. Most companies have a pretty low debt to equity ratio in this industry. So they're at the average worse than median. For every dollar of equity, they have 20 cents of debt. Most mining companies pay a nice dividend. They're at 1.6%. The highest is B2 Gold at 3.6%. They generate 115 million of free cash flow, which is about the average. They rank 9th in market cap at 9.1 billion. IM Gold is number 1 at 45 billion. Agnico is close to them at 42 billion. Price to book is 1.8, so they're trading at 1.8 times book value. Price to book is stock price over book value per share. Negative earnings, so we can't look at a PE, it's NA. PE is stock price over earnings per share. Price of free cash flow is 79, that's stock price over free cash flow per share. That is the highest number on this list, but it's better than the NAs. If a company has NA, that means they have negative free cash flow. Price of sales is at the median, 3.5. They're trading at 3.5 times revenue, which means their market cap is 3.5 times their revenue. And their 5-year annual revenue growth rate is really solid at 22%. Look at Equinox. They're at 61%. That's a gym in Manhattan, Equinox. If you put $10,000 into this company 10 years ago, you'd be pretty happy at $27,000 today at 10% annual return. Roughly the return of the S&P 500. To summarize, I have them trading at an 8% premium, ranking 5 out of 10. Would I buy it? I do like the company, 6 out of 10. Ratios look a bit weak, 3 out of 10. Really high price to free cash flow. We cannot look at a PE because they have negative earnings. Financial, 6 out of 10. Their free cash flow is down since 2021, but it is positive, and revenue is going up. It's up 58% since 2021. Let's take a look at their latest financial results. Revenue 686 million. That is up from the second quarter of 2023, 640 million. Let's take a look at their latest income statement. In the second quarter of 2024, revenue 686 million. Second quarter of 23, 640 million. And for the trailing 6 months, it's 1.3 billion. Up quite a bit from 2023 of 1 billion. Let's get a breakdown of the revenue so we know what it is. Here's a breakdown of the $686 million in the second quarter of 24. $165 million of revenue was in silver, $521 million in gold. They should change their name to Pan American Gold. Here's a breakdown of the $165 million of silver. They break it down by location. $25 million in Mexico, $47 million in Peru, $37 million in Bolivia, $56 million in Argentina. Here's a breakdown of their gold revenue. Mexico, $55 million, Peru, $75 and $43 million, so about $119 million. They have two locations in Peru, Huindo and La Arena. Canada, the Timmins location, $70 million, Brazil, $109 million, Chile has two locations, $109 and $58, so about $167. Here's a breakdown of their revenue by product. Refined silver and gold, $572 million. The refining process removes all the impurities, leaving the pure silver or gold. They have $26 million of zinc concentrate, $39 million of lead concentrate, $19 million of copper, $30 million of silver. Concentrate is in the powder form. It's before it's converted, roasted, and smelted into refined copper, or refined lead, or refined zinc. Let's go back to the income statement. Below revenues, cost of revenue, $569 million. Production cost is their biggest cost, $425 million. The cost to make the product. Depreciation, $128 million, and royalties, $16 million. So their mine operating earnings, kind of like their gross profit, $117 million, up from $88 million. And then they have other expenses, G&A to operate the day-to-day operations. An example is the payroll for the accountant, the rent at their office, and then a bunch of other expenses. So their operating earnings, $89 million, better than last year. They had a loss last year, mainly from a big impairment of $42 million. If it wasn't for that impairment, it would have been positive $36 million. Then you have pre-tax income of $72 million, $93 million of taxes, so they have a net loss of $21 million. Last year, they had a net loss of $33 million. They are buying back stock. Last year, they had 364 million shares outstanding. Now it's 363 million. So they decreased their share count 1.5 million. Let's look at their balance sheet. Current assets, $1.3 billion. Current liabilities, $650 million. So the current ratio is above 2. Current ratio is current assets over current liabilities. It's a good liquidity measure. So it looks like they have plenty of liquidity to get through the next 12 months. Their biggest current asset is inventory, $740 million. And they do give a breakdown of the inventory. Total inventory, $772 million. The reason it's higher than the balance sheet is they have $28 million in non-current inventory. Let's go back to the balance sheet. $28 million of non-current inventory, long-term inventory. Inventory that they don't plan to convert to a sale within the next 12 months. Let's go back to the inventory breakdown. Heap leach inventory and in process is the biggest, $358 million. Heap leaching is part of the mining process. It's when the metals are put into a big pile and leached. Leaching is extracting metals into liquid. Heap leaching is more efficient because they have a mass quantity of product. If this was a small company, they wouldn't have to do heap leaching. They may be able to do it in smaller increments. DR and finished inventory, $125 million. And then they have $200 million of materials and supplies. Their total assets, $7 billion. Their biggest asset is mineral properties, plant and equipment, $5.6 billion, which is the value of all their locations, their mines and their equipment. Here's a breakdown of the $5.6 billion. They break it down between producing mines, $3.3 billion, and non-producing, $2.3 billion. Their biggest producing mine is in Brazil, $1.4 billion, and then they break down each location. For non-producing, the biggest is also in Brazil, $982 million. Each of their locations is pretty big. So part of the Jacobina mine is non-producing. Another part of Jacobina is producing the commodity. Their total liability is $2.4 billion. Their biggest liability is long-term debt, $700 million. They do break down their long-term debt. $274 million of senior notes maturing in 2027, $414 million of notes maturing in 2031. So these notes are going to mature pretty soon. It's a little over 2 years before these notes mature. $275 million is a pretty big number. That's more than their free cash flow for the trailing 12 months. I think their free cash flow is around $110 million. Let's take a look at their statement of cash flows. For the second quarter, they had operating cash flow of $160 million, but they have capex of $75 million. So their free cash flow is about $87 million. Let's look at their operating cash flow. The reason they have negative net income and positive cash flow is because they have lots of non-cash items. Income tax expense recovery, $93 million, and depreciation amortization, $128 million. Let's look at their financing section. They paid $36 million of dividends. They bought back $2.8 million of stock. They paid down $1.6 million of debt, and they had to pay $13 million on equipment leases because they lease a lot of heavy equipment in order to run their business. So in their financing section, they had a cash outflow of $53 million. Let's look at the stock on Simply Wall Street. Its last price, $25, $9 billion market cap, up 1% in the past week, up 64% in the past year. Here's where the stock has been trading since the mid-90s. Looks like it started out at $550. Then in 2000 or 2001, it fell to its lowest point, $244. I could almost guarantee if you merged the price of silver and gold together and made it one chart, it would look pretty similar to this. Because this stock has to trade pretty close to the underlying commodity. It could outperform or underperform in a short term, but in the long term, it should look pretty similar to the underlying commodity. It broke through 40 in 2008, but it fell about 70 or 80%. Then it ran up to 40 again in 2011, and it never hit 40 again. It came way down to $7 in 2015. By 2020, it ran up again, but then came way back down. Pretty volatile. Simply Wall Street values the stock at $10. They say they're 138% overvalued. Two analysts priced this stock at $26. They say it's slightly undervalued. Here's their revenue since 2013. It hovered around $800 million from 2013 until 2018. Then it had a big run up to $1.5 billion by the beginning of 2020. It moved up and down for the next 2-3 years, then a real big bull run to $2.5 billion currently. So their revenue is at the highest point ever. Here's their debt since 2013. They had really low debt for a long time. It got up to $1 billion in 2023. They brought it down to $700 million. But their equity is always a lot higher than their debt, so it seems like they're in good shape. And they have $368 million of cash, which is half their debt. Here's their dividend since 2014. It was over 5% in 2015, and this purple line is their dividend payment. So it looks like they brought their dividend down a lot. Maybe they were struggling financially. So the yield was 0.3%, a 10-cent annual dividend. In 2015, it was 50 cents, so they really cut their dividend a lot. Actually, they brought it way down to 5 cents in 2016. But since then, they've been raising it every year, up to 48 cents in 2022. They cut their dividend again, down to 40 cents, so it's currently at 40 cents. The forecast is 42 cents by 2025, and the yield 1.7% by 2025. So these bars on the bottom are their actual dividend payments by quarter. So you see it was 12.5 cents in 2014. They cut it to 5 cents in 2015. In that line chart, the number I was referencing was a trailing 12 months, so the last 4 dividend payments. These bars are quarterly. They brought their dividend way down to 1 1/4 cent. That was in 2016. The highest dividend they ever paid was in 2014, 12.5 cents. It did get up to 12 cents in 2022, but then they cut it again to 11 cents, then 10 cents. So it's been 10 cents, it looks like, for several quarters now. In the past year, there's been some insider buying and selling. 58% of the company is owned by institutions and 42% by the general public. The New York City investment firm Van Eck is the biggest shareholder at 10%. Then Vanguard, I guess the Vans like this company. Fidelity, BlackRock, Murray Asset Global, Invesco. I think Conwave is a Swiss company. They own 1%. Menora is definitely an Israeli company. RBC, Royal Bank of Canada. Sprott is a Toronto-based company. Dry House is a Chicago investment advisor. I've heard of them before. And their employee count was at 7,000, down to 4,000 in 2016 and 17, up to 7,000, down to 6,200 currently. The ticker trades on New York Stock Exchange, TSX, Deutsche Börse, London Stock Exchange, Mexican Bolsa, and Buenos Aires. If you want to learn how to dissect and pick apart financial statements like the income statement, a statement of cash flows, and balance sheet, click on the video in the top right corner. Thanks for watching.